Welcome to another tutorial video. This time around, I'm going to be discussing how growth equity and buyout deals differ for commercial banks. So a question that came in a long time ago was the following. I've noticed that you have many examples of leveraged buyouts and LBO models for traditional companies. But how would you set up a leveraged buyout model for a commercial bank? I have an upcoming case study at a financial services focused private equity firm. Help. Now, since the time this question came in, we've added coverage of leveraged buyouts, and growth equity case studies for financial services firms and commercial banks specifically, but I still want to go through and answer this question. We'll divide the lesson into two main parts, and first I'll explain some of the key differences in bank buyouts, growth equity, and private equity investing. And then in part two, we'll go through a quick overview and summary of a bank buyout model for MidFirst Bank, which is a regional private bank based in the US. The truth is that there's very little traditional private equity or leveraged buyout activity in commercial banking. Within financial services, you do see more activity in insurance, in specialty finance, in fintech, in brokerage, for example, but there is not that much with traditional commercial banks for two main reasons. First, regulations, and second, deal math. With regulations, the issue is that if a PE firm acquires more than a certain percentage of the bank's voting shares, the PE firm itself may be classified as a bank holding company, and it will have to comply with regulatory capital and all the other requirements that are imposed on banks. Now, the specific percentage differs depending on the country you're in, and in some places it may not apply, but it's always an issue when a PE firm goes above a certain percentage ownership. They may fall under this classification, which they really do not want. The second problem is that most banks are already highly leveraged and they can't take on much additional debt to fund a deal. Debt is more like a raw material than a financial liability for a bank. And even if a bank takes on more debt or increases the amount of debt it has, it doesn't necessarily aim to delever over time. Instead, it's just going to use that debt to fund more loans and other interest-earning assets on the other side of the balance sheet. Another potential problem is that in a bank buyout deal, just like in any deal for over 50% of another company, we write down the company's equity and then we replace it with new equity. And if debt was used to fund the deal, we also reflect the debt on the balance sheet. Since a bank's regulatory capital is mostly based on its equity, we might run into a shortfall of regulatory capital if we write down a bank's equity and we use only, say, 50% equity to fund the deal instead of 80, 90, or 100%. As a result of these problems, most private equity firms have to use 100% equity or close to it if they want to do traditional buyouts. And even outside of traditional buyouts, they will almost always use a significant portion of equity to invest in commercial banks. To get around some of these rules and limitations, PE firms use three main strategies. The first one is that they could structure deals as minority stake investments. So instead of buying 100% of the bank, maybe they only buy 5% or 10% or 20% or even 1% of the bank's common shares. The second option is that they could invest in something other than the bank's common equity. So maybe they buy the bank's preferred stock or their convertible bonds or their mezzanine or something else that does not actually give the PE firm equity ownership in the bank. And then the third option is to do the deal with multiple firms so that they do acquire 100% of the bank total, but each firm has less than 20% of the bank's voting shares. So maybe there are 10 firms and they each acquire 10% of the bank. What all this means is that no matter which alternative a PE firm chooses, a bank buyout ends up looking more like a growth equity deal or a debt investment than a traditional leverage buyout. If you think about the return sources in a traditional LBO versus a bank buyout deal, that becomes really clear. Here's an example. If you set up a returns attribution analysis in a traditional LBO model, the main sources are EBITDA growth, multiple expansion, and debt paydown and cash generation. In a bank buyout model, the first two still apply. Of course, EBITDA doesn't apply. You use different metrics, but you could still expand financially and you could still grow the company's multiple. But this concept of debt paydown and cash generation doesn't hold up because debt is treated very differently for commercial banks. So for a bank buyout model, or a bank growth equity model as well, the returns attribution analysis might look something like this, where the main sources are tangible book value growth, price to tangible book value multiple expansion, and dividends. Now, of course, dividends could also exist in traditional leverage buyouts as well, but they're more common and far more important in the commercial banking sector. Since tangible book value growth and price to tangible book value multiple expansion are the primary goals in bank buyout deals, any PE firm that does this type of deal is going to aim to grow the bank's tangible book value and expand its price to tangible book value multiple. Now, growing the bank's tangible book value depends on how well they can source deposits and debt and grow their loans and keep growing their net income over time. But with the price to tangible book value multiple, you can relate this multiple to the bank's underlying financial metrics with this formula. Return on tangible common equity minus net income to common growth divided by cost of equity minus net income to common growth equals the bank's implied price to tangible book value. Of course, this formula only really works if everything is stabilized, but it still gives you a rough sense of what the bank's multiple should be. So if you want to boost that multiple, you can boost the bank's return on tangible common equity by cutting costs, by growing assets more quickly, by finding higher yielding assets, or by finding lower cost funding sources. You could also try to boost the bank's net income to common growth. And you could also try to reduce the bank's cost of equity by changing its business model, its loan to deposit mix, or just timing the market cycle so that returns expectations are different. Of these, the first method is the most viable because it's the easiest to predict, and usually it's pretty obvious if a bank's returns-based metrics are significantly lower than those of its peer companies and if there are ways to possibly improve them. So let's go into part 2 now and look at this buyout model for MidFirst Bank. You can find the Excel file linked to below this video. Click on Show More and go to the description and you'll see the links down there. Step 1 in a bank buyout model is to make transaction and operating assumptions. And we've done that here. This is a private bank, so we've assumed a purchase price to tangible book value multiple. It's a multiple of the bank's tangible book value, 2.5x, so we get to an equity purchase price around 3.1 billion. We have some transaction fees. We've also assumed an exit multiple up here, and we can calculate it a couple different ways. For the operating assumptions, we've assumed a certain growth rate for the bank's gross loans. We've assumed that many of these items are percentages of the bank's deposits, and we've assumed deposits are also a percent of the bank's gross loans. And you can see many of these assumptions going forward over here. A lot of these other items are also percentages of loans, whether you're looking at long-term debt or accounts payable. And then on the other side of the balance sheet, the allowance for loan losses is also a percent of loans. So this is a very, very simple balance sheet because it's just intended to illustrate the basic concept of a bank leverage buyout. Step 2 is to set up a sources and uses and purchase price allocation schedule. It's very similar to what you do in an M&A deal, but we just have one company to worry about here. Now, sources and uses in a bank buyout or growth equity deal is pretty simple because you're just paying for the equity of the bank and possibly for transaction fees. Under purchase price allocation, for growth equity deal, you wouldn't do much of anything here. You might adjust a few items on the balance sheet and then reflect the additional equity and additional cash, but you wouldn't go through all this where you write down the seller's common shareholders' equity, the goodwill, the intangibles, and then you create a whole bunch of new items. But for a deal where you buy 100% of the bank, you will make these adjustments. You'll write down the bank's allowance for loan losses. You will write down intangibles and then create new intangibles. You'll create a new deferred tax liability for these items where the depreciation and amortization will not be deductible for tax purposes in the future. So you go through that entire process. In step 3, you adjust the bank's balance sheet. And I have some of the key items here, but for example, you reduce the bank's cash to pay for those transaction fees. If you're marking the bank's loan portfolio to market value, you'll do that, and you'll almost always adjust it by at least 1, 2, 3%, something in that range. You'll write down the allowance for loan losses. You will write down goodwill and intangibles and create new items. And then on the other side, you will create a deferred tax liability. You may adjust the values of the debt the deposits and other items as well, although we don't do it here. And then you'll write down equity and replace it with the new equity that the PE firm is using to buy this bank. After that, you'll project the balance sheet and the federal funds items, which are used to balance the balance sheet. So over here, for example, if we look at this future period, we've used a simple growth rate for the gross loans. We've made the allowance for loan losses a percent of the gross loans. And many of these other items, such as cash, are percentages of deposits. Securities grow independently. Federal funds sold and federal funds purchased on the other side are used to balance the balance sheet as you normally do for banks. If a bank has too much funding, it can sell back some of it in the form of federal funds sold and earn interest on it. If a bank needs more funding, it needs to borrow from the central bank and it'll pay interest on that. In step 5, you project the income statement and cash flow statement. If you have a cash flow statement, you don't necessarily need one for a bank. Here, our income statement is very simple because it just consists of net income, which we've projected based on an assumed return on assets for this bank. We just multiply that return on assets by the bank's average total assets to get the net income to common. We don't have a cash flow statement here. And then we project the regulatory capital and dividends for the company. Once again, this is very simple because it's just illustrative. It's not for a real deal where we'd have tons of detailed financial information, but we base the regulatory capital on the bank's common equity tier 1. We make risk-weighted assets a percent of interest earning assets, and we calculate the bank's common equity tier 1 ratio. We also figure out their targeted common equity tier 1 ratio, which we assumed up at the top. If you go all the way up to the top, our targeted ratio is 10%. What that means is that if we get to over 10%, then the bank can issue dividends. If not, then the bank cannot issue dividends. So in the first year, we're using the beginning balance. So we're actually below it initially right after the deal takes place. But shortly after that, we go above that 10% level. And so the bank keeps issuing dividends. And as a result, the bank's common equity tier 1 ratio stays at around 12 or 12.5%. And then finally, we calculate the money on money multiple and IRR and build sensitivities and a summary at the end. So let's go down and actually do this right now and fill in everything here so you can see how it works. For the investor equity, let's go up and link to our equity purchase price right there. Dividends, I'll just enter 0 and then we'll sum these up. Now, for the rest of these numbers for investor equity each year, I'm just going to enter 0 until the end. When we get to the end, we'll take the bank's tangible book value. We're assuming that its common equity tier 1 and tangible book value are roughly the same. Not true in real life, but for our simple approximation here, it's fine. And then we'll multiply by the exit price to tangible book value multiple that we selected from our assumptions in the beginning. We have that. And then dividends will be the other main source of returns to equity investors here. So I'll link to our common dividends issued right up here on our income statement. I'll add these up and then I will copy this across. So we have that. And then let's go down and calculate the money on money multiple. So we can use a sum if here and we'll use the net cash flows range right here. And we'll start by summing up everything that is above 0. We'll use this for the sum range. And then we'll divide by everything that is below 0 over the same range. And I should have used a negative sign in front of that, so I'll fix that right now. Then to calculate the IRR, we just have a simple annual model here, so I can use the built-in IRR function in Excel. We get to 19.3%. The rough math here makes sense because over 5 years, a 2.5x multiple equates to roughly a 20% IRR. We're just under 2.5x, so our IRR is just under 20%. And then if we do our returns attribution analysis, we could look at tangible book value growth first. We'll take our ending tangible book value and we'll subtract the starting amount. We'll then multiply this by the purchase price to tangible book value multiple up there. And then for the multiple expansion, let's go up and take our exit multiple. We'll subtract our purchase multiple. And then we'll multiply by the ending tangible book value right over there. Dividends we can back into by summing up everything here, all the returns to equity investors. And we get to everything like that. So we have our IRR, our multiples, our returns attribution analysis, and we even have some sensitivity tables down here that I've already set up off screen. The next step now is to evaluate this and think about this critically. At first glance, this doesn't seem like a great deal because if you look at the sensitivity tables, if we just focus on the one with the exit multiple and purchase multiple, to get to around a 20% IRR, we need to go over a 3x price to tangible book value exit multiple. Now keep in mind, we purchased the company for a 2.5x multiple. The problem with this is that the company's return on assets was around 2.7% in the beginning and is about 2.3% by the end. Return on tangible common equity was 28%, falls to 27% or 26% by the end. So we have lower returns-based metrics, but we're asked to believe in a higher exit multiple. Also, if you look at the sensitivity table above it seems like we need to improve our return on assets by at least 10, 20, 30% to get to above a 20% IRR. So based on that, we're not too confident of this deal, but to evaluate it more fully, we'd have to look at other scenarios and sensitivities and do some more detailed analysis. That's about it for our summary of bank buyout and growth equity deals. To summarize, the key differences are that in most cases, PE firms tend to make minority stake investments in banks rather than traditional buyouts, or they'll invest in preferred stock, convertible bonds, mezzanine debt, or something other than common equity. Or if they do a traditional buyout, they'll join together with other firms so that no one owns more than 10 or 20% of the total bank. As a result of all this, most bank buyout deals are actually more like growth equity deals or debt investments than traditional leverage buyouts. In the bank buyout model, much of the setup is similar, except the multiples and metrics are all different. And when you calculate the returns, you have to think about regulatory capital and link dividends to that. When you calculate returns at the end, there is no debt repayment or cash generation. There's just the equity purchase price, the exit equity proceeds, and the dividends that you get in between. And then you can trace how much of the returns comes from multiple expansion versus tangible book value growth versus dividends. That's it for this tutorial. Hopefully now you know a bit more about bank buyout and growth equity deals.